Well, moving on now, let's focus on earnings. And HDFC Life is really the stock in question. Look at the stock right now. It's recovering and it's undoing a lot of the damage that it saw yesterday. It's very clear that the conference call that the management had post-market hours, that's kind of sort of soothed nerves, and it's kind of put to rest some of the concerns out there on the margin front specifically. In fact, the total APE and the retail APE for the company beat estimates. The VNB margin was below expectations. Our colleague Yash caught up with Vibha Padalkar, the MD and CEO of HDFC Life, and began by asking her about the APE growth as well as the guidance for this year. Take a look.
I mentioned that in the first half of the year, that growth on the upper end would be around 15%. We are revising it to say growth for the full year FY25 should be in the range of 18 to 20%. The reason why this gives me the confidence level is the first half of the year on a WRP basis, we grew very well at about like you said, 28%. APE basis, we grew by 31%. Whichever way you look at it, very good levels of growth, beat both the industry, overall industry and the private sector very, very comfortably. Market share expansion of 60 basis points. We achieved a watermark of 11% in terms of overall market share of the sector. And many such underlying nuances in terms of retail protection continuing to be strong. Number of policies growing at 22%. So very, very wide spread growth rather than concentrated. Tier 1, Tier 2 and Tier 3 growing very comfortably in their 20s, different levels in 20s. Agency channel roaring back in terms of growth being faster than company level growth. So any which way you cut it, growth has been extremely secular, and that gives us the confidence that the buoyancy that we're seeing in this sector hopefully should see us through towards the end of the year. Last point I want to make is some of the hesitancy, like I had mentioned to you last time, was because of the rollout of surrender charges that was causing a little bit of uncertainty because we didn't know, is it going to get rolled out on 1st of October or not? So that's now behind us. It has got rolled out. 95% of our products are now compliant. So we have all the products in our arsenal to be able to go out and sell. Conversations with our 300 plus partners are very constructive. And I think in a quarter's time, towards the end of this quarter, quarter 3, even that will be history, and we will move into a business as usual mode in quarter 4.
The last interaction, of course, you had spoken about a guidance of 17 to 18% on the value of new business. You're on track as far as the first half is concerned, because there you see a growth of 17% on VNB so far. Confident of maintaining this growth rate and sticking to that guidance of 17 to 18% on VNB? And is there some sort of an upward bias to that 17 to 18% as well?
Yes, so we will target in that range, and right now I'm saying 15 to 17% with the we've already reached at 17%. Now, in terms of upward bias, I will have a better view on this by the end of quarter 3, early quarter 4. There are multiple conversations, as one can imagine, due to the surrender charge implementation on all the products other than unit-linked products. So it's fairly significant. And we are in a multi-tie situation in each one of our relationships. So we have conversations with our partners. Partners have conversations with other insurance companies whose products they sell. They come back to us, they come back to them, and so on. So all of that is going on right now. So things will settle down over the next, in this coming quarter. And we will certainly have a better handle. All things being equal, I think we should be in a slightly advantageous position on margins versus peer set.
Slightly advantageous position on the margin. And that's exactly what I want to speak to you about. For margins, what you had guided the street for as far as FY25 is concerned is 26% plus minus 100 basis points. Now, as far as the first quarter of FY25 is concerned, the margins came at 25%. Second quarter, they dipped a little out of your guided band to 24.3%. Now, what that takes the H1 margin to is about 24.65%. Very clearly, what I want to understand from you is that in the second quarter, what were those couple of things which impacted the margins to make them fall out of your guided band? And are those problems, are those concerns here to stay for the rest of the year, or could they see an improvement and help margins to go up?
Just to deconstruct quarter two on a standalone basis, last year was 26.3%, somewhat in a different era because equity markets were very different. But nevertheless, 26.3% versus 24.3% in standalone quarter two of this year. This 200 basis points differential is explained as follows. 100 basis points was simply because of product mix and largely because of unit linked, what we have been articulating. For example, in H1 last year, unit link was about 28%, and that increased quite significantly in H1 this year to about 36%. So largely due to unit link and a little bit due to annuity, but I would stick with unit link. So that is of the 200 basis points, 100 basis points is due to product mix. Another 100 basis points is because of a conscious call on repricing of our non-par products that we had to phase out. I'll explain. So we had to phase out some of the earlier products that would no longer be compliant after 30th of September. Given that 40 odd products had to become compliant in a very short period of time, and this is, when I say compliant, all the features in the product brochures, but more importantly, on our IT systems. And you can imagine all the nuances because earlier there were no surrender charges at the end of first year. So we had to redesign our IT processes and the customer facing the system to be able to change the product itself, the product architecture itself. So all of that takes time. So we had a toss between, do we reprice our old products that are anyway going to be phased out, which would keep keeping some of our new products on the back burner. Hence, we took a call that it is important for us to have new products from the word go on 1st of October. And hence that somewhat delay in the pricing by about 3 weeks had a 100 basis points impact on our margins for the standalone quarter. On H1, it's about a 30 to 40 basis points impact on H1. But on a standalone Q2, it had about 100 basis points impact.
Okay, so if I understand that right, of course, leaving the point on growing ULIP out of the total APE share aside, there was certain amount of price increase which was deferred by about 3 weeks, as you pointed out. And if that wouldn't have happened, it could have added 100 basis points to the margin straight away. Is that correct?
Yes, except that it would be price decrease. We had to price it downwards because of interest rate movements. These were on a non-par product. But we held on to whatever were the prices, and that had a 100 basis points
impact. Okay, that clarifies one bit, on the margin impact. The second one is, of course, a growing share of ULIP portfolio out of your total AP. I remember the last time that we had spoken, you had said that, boss, ULIP share is rapidly coming down. We won't have to wait for too long before it comes down to sub 30%. I want to understand from you, between the first quarter and the second quarter of FY25, what is the movement that has come about as far as ULIP share of total APE is concerned? In the second half, do you expect this share to go up again? If you could clarify on both these points.
Yeah, so first quarter, ULIP share was about 38%. In Q2 standalone, it had come down to about 34-35%. Some of our channels, say our agency channel, came down to sub 30%. Overall, bancassurance was still a little bit elevated, but some channels got there even quicker. And what we, as a strategy, when we looked at the customers that have come on board, our customers onboarded in quarter two, more than 70% of those customers are new to HDFC Life. Now, our realization is that, yes, ULIP margins are lower, but these customers are new to us, and our ability to sell to these customers is going to be quite meaningful. Upsell other products more margin accretive products, different solutions to these customers and their family members. So rather than saying no to these customers, in the pecking order, let's go for growth. Let's go for increase in or growth in value of new business, and margin will be an outcome, like I mentioned last time. However, with the caveat that there will be a floor to the margins. Margins are not going to be in a free fall, but we're not going to be tethered to a particular margin.
Well, that is HDFC Life, and stock is up 2% as we speak. By the way, the